Good afternoon, everyone. It is July 15th of 2024. This is Robert Rayburn here at Life Pro Asset Management. Hope that everyone had a great weekend. Certainly had an interesting market over the last week. The big event, of course, was the inflation report as inflation continues to come down. And in fact, we saw deflationary month over month numbers. What that's doing is the big message here is that it's opening the door for lower interest rates in the back half of the year. Now, that presents opportunity, but it also presents potential cost for savers. So we're going to go through all of that this week, what it means for your portfolio, what we're doing to position for an environment where rates are not going up, but coming down. So let's go ahead and get started. I'm going to share my presentation like I do every week. And the title of this week's presentation is Are Interest Rates Heading Lower, right? There's always a risk that they don't. But when we look at the data, we look at commentary from the Fed, it certainly seems likely that we're going to get a move lower in rates, at least at the policy level, in the fall. Now, things can change, data can change, we can be surprised, right? And that can change the outcome. But as the data looks now, we've had 3 months of really good disinflationary data, 1 month of deflationary data. Things are looking the right way. The labor market has started to soften. So remember, the Fed has two mandates. One is to manage inflation. The other is to manage employment. Employment's starting to soften. Inflation is starting to come down. What the Fed wants to do now is prepare the economy for that slowdown, right? So to counter the slowdown, they're going to start to lower rates so that we get that soft landing and potentially reaccelerate upward without that inflationary component that we had back in 2022. Sounds like a lot, lots of things can happen. The economy is a complicated machine, but that's the objective here that the Fed's trying to do now that the inflation surge has largely ended. So three big things that we're going to focus on this week. Are lower rates positive for stocks? I think sometimes we just equate lower rates by stocks. So it's a little bit more complicated than that. So we want to answer that question of when are lower rates positive for stocks, and when they are positive for stocks, what type of stocks do we want to focus on? Number two, what's the impact of seasonality on stocks and sectors during elections? And then lastly, credit markets. We'll go through that, but bottom line here is that they do remain supportive for equities and risk on types of strategies. So what happened? Overall, consumer inflation came in far below expectations, posted a negative month over month number. That's important. We haven't seen that. In fact, when we look at the inflationary data, it's the lowest month over month increase, or in this case, a decrease that we saw since May of 2020. And if we go back to May of 2020, that was right in the thick of the COVID shutdown. Prices were falling. Remember back when housing was actually falling? That was the case back in May of 2020. Kind of wish I bought my house during that time. So that headline CPI came in. CPI just stands for, by the way, Consumer Price Index, fancy way of saying inflation. Came in 3% year over year versus 3.3% the prior month. As we talked about before, negative 0.1% month over month. So all of that's great. Inflation's coming down, negative month over month, below expectations. But why does it matter? Why does it matter for your pocketbook? In other words, I think that's more obvious. We don't want to see prices going up in the grocery stores and other items that we buy. And the more complicated question is, what does it historically mean for stocks? And like everything with the market, the answer is it depends. Inflation and rates gradually coming down is bullish historically. Historically tends to be bullish. Inflation and rates crashing down tends to be bearish. Now, why is that? When inflation and rates are gradually coming down, it's usually the sign that an overheated economy is just starting to cool off, right? We're getting to a more sustainable world, right? Where in a developed economy, we're growing at 2%, inflation's at 2% or lower. everyone's happy, right? Nothing is out of whack. When the economy is growing 5 or 6% for a top tier economy like the US, things tend to get overheated, right? Um, Now, you can have 4, 5, 6% GDP growth when you have a productivity boom, right? So in other words, people are working the same amount of hours, but they're producing a lot more in those same amount of hours. And that's actually one of the big promises of AI, artificial intelligence, this idea that we could go through this massive productivity boom. We haven't seen that yet, but if that does happen, that is, you can get a 5, 6% GDP number without the overheated inflation numbers. Again, that hasn't happened. So when rates come down, inflation comes down gradually, Wall Street's able to adapt, traders are able to adapt, investors are able to adapt. That tends to be bullish. When inflation and rates crash down, right, where we go from a 10-year at 10 and or not 10.5%, we go from the 10-year at 5%, and then 2 months later we're at 1%. That's not good. That means something really bad has happened, and people are pouring into treasuries as a rush for safety. So that's not good. We don't want to see that rush, that panic into safety. That does not tend to be good for risk on when inflation and rates crash. When inflation's going from 4% to 0%, it's because the economy has suddenly crashed. And that means people are selling stocks too. What's a good example of that? Well, 2008 was a great example of that, where inflation was at one point was at 5 or 6%. By the end of the year, it was negative, and rates went from 5, 6% to zero. Right, that famous ZIRP policy, zero interest rate policy, came into effect by the Fed, responding to the bank collapse. That's the problem, is that those types of situations are usually accompanied by something like a bank collapse. We don't want that. So scenario number one is what we want. Scenario number two is not what we want. So what do we see today? And interest rates and inflation are gradually coming down. It's been a process over the last 6 to 8 months. That's good. Economic growth is slowing, not crashing. So that tends to be good for risk historically. So interest rates are starting to drop. This is the 2-year interest rate, which tends to be aligned with which tends to sort of be a vote on where Fed policy is going. 10-year rates are doing the same thing. You're going from about 4, you've been in that 4.5 range. We're now at around 4.18 or so as of the time of this recording on Friday. So what works? What works in that type of environment? So when you have lower rates, lower inflation in a non-recessionary environment, it tends to benefit companies and countries that rely on lower dollar funding rates, right? So if you have a company that has a high debt load, believe it or not, those stocks are going to outperform. Those are the stocks you want to buy that have a high debt load, that can refinance their debt from 6, 7% to 4%. It's hard to pitch that to the client, say, hey, we're going to buy this crappy company with a lot of debt because the stock's going to really outperform because we're refinancing all that debt at a much lower rate. But the reality is those types of companies tend to outperform. Companies that burn through cash because they're in high growth mode, they tend to outperform because that terminal rate way out in the future is being valued at a much higher present value as rates come down. So those negative, what we call profitless tech companies tend to outperform. The other areas that tend to outperform, emerging markets. Why? Because emerging market countries and companies usually fund their debt in US dollars. So when US dollar costs come down because interest rates are coming down, it makes it cheaper for those countries and for those companies in those countries to fund themselves. So those types of markets and stocks tend to outperform. And of course, long duration bonds. We talked a little bit about this last week and the week before. If we see rates coming down, guess what? It's time to roll up our sleeves and buy some longer duration debt, right? A, we want to lock in those higher rates for a longer period of time. And B, when rates come down in a non-recessionary environment, those bonds tend to outperform. We're already seeing the market starting to sniff this possible scenario out. What happened on Thursday? We saw a very bad move in the NASDAQ, right? Because everyone's been hiding in those 6 or 7 Magnificent Seven stocks, those stocks like NVIDIA or Amazon or Apple or Facebook. Everyone's been piling into those same 7 stocks. The rest of the market has not done so well this year, right? It's been up 1 or 2%. The S&P 500 equal weight, I think it was up probably 3 or 4% versus the S&P up like 15. Strip out the 7 from that equal weight and you get a really you get a number that's even lower than 3 or 4%. So the rest of the market's been relatively stagnant. You saw this big boom though happen on Thursday. It was like this large thunderclap that came out of nowhere that we've been trying to communicate and talk about for months. And we pre-positioned for this move ahead of Thursday's CPI, right? Which is that as inflation comes down and we start to get lower rates, the rest of the market is going to catch up to those 7 stocks. We believe that because the rest of the market looks really cheap. And so I got to figure out a way to source the funding to buy those stocks. Oh, I'm going to start to sell some of those Magnificent Seven names to buy the rest of the market. And hence what you saw on Thursday, which was a headline S&P and NASDAQ that were down a lot, but the average stock was actually doing pretty good, right? So that's how we're positioned. That's our worldview, is that emerging markets, rest of the S&P outside the Magnificent Seven, MSCI EAFE, which is your Europe, Canadian, Japanese markets. Those markets represent a lot of potential value and significant upside in our opinion. And so we've been overweight those areas, underweight the Magnificent Seven areas. So what did we see on Thursday? Small caps exploded with advancers versus decliners advancing 18-1, right? So the last time we saw that was back in 2023 when the Russell had a very significant rally. Technically, coming out of this, what we call this rising wedge consolidation period, exploding out of this wedge to the upside with extreme volume, extreme advanced decline ratio of 18-1. So all of this indicates it's a symptom, right? Not a guarantee, but a symptom that something is changing. And so we want to pay attention to symptoms. So in summary of the market action here, slowing growth, lower inflation, lower interest rates, right? The economy is cooling off, but it's not in a recession, in our opinion, of course. So we do believe it's a good time to shift out of the spots that people have been hiding in, which is mega cap tech, and shift into those areas that may benefit from lower rates, such as small caps, high growth tech, X Magnificent Seven, emerging markets, MSCI EAFE, high duration bonds. Those are the areas that we're favoring. That's how we've constructed the portfolios throughout this year. Now, as it relates to the market and the election, I know that's a big concern for people. Real quick here, during elections, so we look at the 2020 example, 2016, 2004, 2000, 2012, 2008, 1996, 1992, we've had a gap, right? Now, 2008 is your extreme example because it just happened by coincidence to fall during the global financial crisis. The election didn't cause it. Bad underwriting by the banks caused it. So to be very clear, it wasn't the election that caused 2008. But outside of that, we tend to get a little bit of a pullback in the market, right? Tends to take a breather, right? Sell the rumor, buy the news. Sell the rumor, buy the news. All these examples, sell the rumor, 1996, buy the news. Why is that? Because sometimes the Republicans win, sometimes the Democrats win. Why is it this sell the rumor, buy the news? Because the markets don't like uncertainty, right? So once the election happens, what do we have? We have certainty. You know, I guess unless we have 2000 happen, right? We have certainty. We know who's going to be in power. So we know the rules. We have a good idea what the rules are going to be. High regulation, low regulation, high taxation, low taxation. M&A approvals, M&A scrutiny. We know what the rules are going to be. So we can have a playbook and we can invest based on those rules, right? I always say it doesn't matter if Republicans or Democrats are in power. We just need to know the rules and we can make money that way. So that's a big reason why markets tend to rally after the election. The more important message, I think, is the trend, right? So when you have a strong first half, it's sort of like momentum with a car. If you have a car that's going 10 miles an hour and you take the foot off the gas, it's going to slow down pretty rapidly. Markets are not unlike humans and other objects in space and time that rely on physics, right? So if you have strong momentum, it tends to like carry itself throughout the end of the year, right? So if I'm pressing on that gas car 90 miles an hour, the car is going to tend to propel itself on its own by that own momentum for a decent amount of time until it starts slowing down. So the markets are very similar in the sense that you have a strong first half. It tends to historically carry itself into the end of the year. So what we see here is that overall, when we have a strong first half, it tends to carry into second half performance, right? So the top quintile of first half performance aligns with this, with the y-axis here, in the sense that we get a strong second half. So strong first half historically leads to strong second half. From a seasonality standpoint, again, we look at the final 25% of the year. So Q1 tends to be seasonally positive. Q2, Q3 tends to be choppy. And you end the year with a strong second half of the year. So seasonality, embrace the Q4, embrace the election, because you bring certainty to everything. Corporate spread wise, credit markets remain healthy. Nothing's changed here, so I'm not going to add a lot. Tends to be good for risk on activity. So key takeaways here is that the inflation report from this past week potentially has opened the window to lower interest rates, which means likely, in our opinion, short and long-term treasury rates are already falling, right? But likely a vote on where the bond market views Fed policy in September and October, which is that potential for a 25 or 50 basis point rate cut. Market's been shifting toward that 50 basis point rate cut. Lower rates tend to benefit small caps, emerging markets, developed markets outside the US, such as Europe, Canada, Japan, and of course, profitless tech. And then lastly, that strong first half, we think, does carry into a strong second half despite the election. So that's what we got for you this week. 888-543-3776. Please reach out to your advisor if you have any questions. In the meantime, have a great week, and we'll speak again next week. Talk to you soon.